Speaking of inventories, inventories are just current assets. And when preparing financial
Mhm.
statements, you would have statement of profit or loss and say the statement of financial position. Now, inventories are shown on the face of the statement of financial position. By showing inventory there, it means that you recognize them, but you cannot recognize something the value of which you cannot determine. So what to do here, you just have to know how to measure inventory. So this standard gives you everything about that, right?
Right.
But not just that, at the end of each accounting period, an inventory count is usually made so that we know the value of the closing inventory that we use to make an adjustment in the income statement, as well as in the statement of financial position. So we also learn here the method called FIFO and AVICO. Have you ever heard of this one, FIFO and AVICO methods?
Your voice is cracking down very badly. I'm sorry to say, but I'm not able to understand anything.
All right, maybe let me switch the mobile carrier. Let me switch the mobile carrier. Let me switch to another carrier. Yes. Yes, hello?
Yeah, I can hear you.
Yeah, maybe, one carrier sometimes has problem. I just switch the mobile carrier.
Okay, okay. Yeah, we can
So now
start.
now it's all fine, right?
It's yeah, you can start and then I can understand like what you're saying then.
All right, all right. So what I was just saying is, when dealing with inventories, you just need, when you recognize inventory in the statement of financial position, you would need to know its value. So you have to know how to measure inventories. So we'll learn how to measure inventories, but also we'll learn different forms of inventories. But also, as I told you, at the end of each accounting period, an inventory count is usually made so that you truly need to know the value of the closing inventories. As you know, closing inventory is adjusted in cost of sales as well as shown in the statement of financial position. Is that right? So, simply speaking, we could just start with these inventories. And how are we going to go about this? Inventories are just assets which are, that inventories are held for sale for the ordinary course of the business, right? Let's say
Mhm.
you have purchased inventories and you need to sell them. That's one form of inventory, but also inventories, can come in form of raw materials. And so they can be used in the process of production for such sale. Maybe you just use something in the process of production, but also inventories can come in form of materials or supplies to be consumed in the production process or in the rendering of services. All these forms would bring to you inventories. Do you hear me well? Hello?
Actually,
Yes.
yeah, I'm not understanding like
Yes.
maybe can you slow down your speaking a bit so that I can
All right.
understand it?
Yes, yes, I get you. Now,
Yeah.
in simple terms, inventory in simple terms just means stock held by the entity. Inventory can come in different forms. You could have raw materials, right? Raw
Mhm.
materials comprise inventory that has not been started in production. But
Yeah.
also, when producing a product, at the end of the period, you can be, maybe you can have completed 60%, 70%, or 80%, let's say, and that product would be partly finished product, which we usually call work in progress. So work in progress is another form of inventory, right?
Right.
But also at the end of the period, there are products that will be complete, that would have passed the full phase of production, and these are called finished goods. So this is also inventory, right?
Mm. Right.
Yes, but actually there are some businesses which you call, most retail businesses, they just buy goods that are already complete and they sell them as they are. So we call this merchandising or goods purchased for resale. Someone buys the bread and sell them just like
Yeah.
that. So these are just examples of inventories. But also, let's say maybe you could have some consumable stores, just like oil. Let's say you have oil for making operations, operating your cars. That will also be known as inventories. So that's just an example. Now, this point here and here in the adjustments, it's no big deal, but I just need to remind you one thing. Let's just go back to this whiteboard here and you have to tell me one thing now. How do you obtain cost of sales? Let's start from here. Cost of sales, you know cost of sales, right?
Yeah. So
Yes. How do you cost of sales? How do you obtain it?
how do I obtain it? Like purchases
Opening inventory, yes, plus purchases, you said.
less control, less closing inventory.
Exactly. This is how we do it, right? So you just need to know how to do this in ledger, actually in double entry terms. Suppose you are told to write journal entries. How do we deal with opening inventory, but also how do we deal with closing inventories, right?
Right.
That's what we need to make an adjustment. So as for opening inventory, we say, as for opening inventory, as you see here, it comes and increases cost of sales. You know, cost of sales is an expense. And so cost of sales increases an expense. So I would say debit, cost of sales. You know, an expense has a debit nature, right? You know that?
Yeah, that's right.
Yeah, so I'll have to debit cost of sales just like this, but also I will have to credit inventory. So if I have my inventory in store, I would have to credit it, meaning that I've removed that inventory and taken it to cost of sales.
Right.
Yes, but as for closing inventory, when saying closing inventory, this is at the end of the year. Closing inventory, as you see here, we eliminate it from cost of sales and we show it in the statement of financial position, right?
Yeah.
So in the statement of financial position, this is what I'll have to do. I would have to debit inventory like this. Let's say this one. And also I would have to credit cost of sales. Now we are crediting cost of sales by the same value of inventory. It's just a normal entry, but most students make a lot of mistakes here. Especially, let me ask you one thing. Have you ever studied a standard called S8, accounting policies, estimates, and errors? Have you ever gone through that?
Did a bit of it, but not most of the time, like not really actually.
All right. Now, you know, that one is very common because most accountants make errors when doing financial statements. And so suppose there has been an error in inventory. It could arise that you have to adjust for both opening and closing inventories. And these two entries would be very, very crucial. So you just have to take them really, really seriously, right?
Yeah.
Yeah, something like that. Something like
Yeah.
that. So let's just go back to where we were. I'll just go back there, here. So I was just explaining these year-end inventory adjustments, and we can go further down, measurement of inventories. Now, whenever you find the term measurement, it's very essential. Let me tell you one thing. Or let me ask you one thing. Can you tell me the difference between disclosure and recognition?
Disclosure
And recognition.
oh, disclosure is when you have to make disclosures in the financial statement notes, and the recognition is when you actually realize that
No,
value
listen,
in
wait. You spoke very well. I just needed to hear from you the word notes. You mentioned the word notes, disclosing the notes, right?
yeah, the
But
financial statement notes.
yes, but truly, when you say the true meaning of disclose is just to make open, to make someone aware of something, right? So
Yeah.
even when you write, even when you are in the statement of financial position and you write the word inventory and you say it has a value of $200 million, suppose, that is also a disclosure, right?
Sorry, what is disclosure again?
I'm saying that disclosure is just making something apparent, making something known to someone. So
Right.
even just even just going to the statement of financial position and say an inventory line, let's say it's 200 million, that is also a disclosure, as well as in the notes. In the notes, if you give further information, you have disclosed, but you have not recognized. So the main difference between recognition and the disclosure is When you say you recognize something, it must appear in the statement of profit or loss or statement of financial position. But just disclosing, it's also a disclosure. If you recognize, it's obvious that you have also disclosed. And that's why most of times when you read the word disclose, they mention the word notes, because you would have disclosed something in the notes, something that was not recognized, you disclose it.
Yeah, right.
So it's just nice to know that. Now let's go to measurement of inventories. If you go to the statement of financial position and say inventory is equals to this value, that means you have measured, you can measure it. That's why we are confident of putting it there. Even if you have inventories worth 200 million, but you cannot prove that you incurred that cost, if you cannot measure that cost reliably, you are not entitled to recognize that inventory because you cannot measure it reliably. And so, whenever you recognize something, you truly have to know how to measure it, right?
Yeah, right.
So here we are. Inventory states that inventories should be measured at the lower, this is the very, very important point, at the lower of cost and net realizable value. This is a must. You should measure inventories at the lower of cost and net realizable value. Let me ask one thing again before going further. Have you ever studied the standard called impairment of assets?
Yeah.
Yes. If you have gone through that, that standard impairment of assets just helps to determine impairment for standard that cannot find impairment by themselves. Inventory IS2 finds impairment by itself. It does not need that one. Can you remind me, impairment of asset I-36 compares what with what to determine whether there is an impairment or not? Can you remember that?
Impairment of the inventories?
Yeah, I-36. It usually compares carrying amount and what?
Sorry, I didn't understand what you're asking.
I was asking if you remember, for impairment
Please,
of assets.
Sorry, can you speak a little slow?
All right. I was saying that if you remember, for impairment of assets, how do you determine whether there is an impairment or not?
Oh, if the realizable value is lower than the market value, then that is one of the criteria, and the second one is,
for example, let me show you one thing. Do you remember? If you just remember this, let me write something here. If you go to the standard called impairment of assets, I just need you to have a full picture. There is a standard called A36 impairment of assets. If you have ever gone through this, I just want to have a picture here. Impairment of assets.
I have been I've seen it, but I don't remember it now.
All right. So simply speaking, you can just go directly if you do, because there's not much need to go there. So inventory should be measured at the law of cost and net realizable value. Cost is what you incurred to acquire that asset, that inventory, right?
Right.
And net realizable value is what you get after selling that inventory.
Right.
Actually, you check that the sales you receive, and you deduct the cost that you have incurred to make sure that the sale has been made.
Right.
Yes. So this net realizable value is explained down here, that you take the estimated selling price of selling something less the estimated cost of completion. You know, you can have an asset, you can have inventory that is not in a sellable condition.
Yeah,
and
that's
so,
right.
yes, you have to incur some workout cost to complete it. And after that, you could have to take it to the market, and you could incur estimated cost necessary to make the sale. So if you deduct all those costs, what you remain with is what we call net realizable value, right? So that's what you have to know. And all right, in some cases in exams, you could be asked to explain principal situations in which net realizable value is likely to be less than cost. Because as we said, we measure it at the law of cost and net realizable value. So in case NRV, net realizable value, is less, it means that we would have to adjust our inventory amount, right?
Right.
Yes. So here we come. These are just some examples. So you just mention anything that would either make the cost to be higher, or actually just mention anything that would make the net realizable value to be lower. If you just look at the above here, you could see that there could be an increase in cost or a fall in selling price. Because
makes sense.
if the selling price falls, NRV would fall. If this cost estimated cost necessary to make the sale rise, NRV would still fall.
Yeah, that's right.
So that's just the natural phenomenon. But also, there could be an issue on physical deterioration in the condition of inventory. If inventory deteriorates, it's obvious that the selling price will fall naturally. You cannot sell it at its original price, right?
Yeah, right.
Number 3, obsolescence of products. You can have the products that are obsolete. Let's say a new technology has come up, which is very, very much fine, and your products would look inferior and you would have to lower the price. That's just an example.
Right.
Yes, but it could arise as a decision as part of the company's marketing strategy to manufacture and sell products at a loss. Let's say there is a stiff competition and you need actually to beat your competitors. So let's say you incur $2,000 to make a product, but you sell it at $1,500.
Yeah.
Yeah, just as a marketing strategy, maybe to oust out your competitor so that you can remain as the market leader in the market.
Yeah, that makes sense.
Yes, but also you could maybe have something like this. Let's say errors in production or purchasing. You could have made an errors in production. If you make errors in production, the product won't be complete, and so it won't have a sufficient quality, and you will have to sell it at a much lower price.
Right.
So we're just speaking of this. Now, let me tell you one thing. Whenever you start financial reporting, you should really know how to make the double entries. Studying IFRS without doing double entries is usually meaningless.
That's right.
So let me ask you one thing. Let's just do this. Let's say you have inventories with the cost of $100 and an RV of $80. We said that the rationale is to measure it at the lower of these two. You know, in your books, you would have something at cost, right?
Yeah, that's right.
So what would you do? What would you do to make this 100 go to 80?
So I will just record the net realizable. Wait. So I will credit the inventory for $20, and I will debit the cost.
The what?
For $20. Cost.
You debit the cost.
Sorry, no. I have to credit the cost. I have to credit the cost, but then how will the next time?
Listen, you spoke very well. You said that you would credit inventory by 20. That's very, very fine.
Right.
I just need to know the other side. And that's where the importance is. And that's why I wrote this question, so that we discuss that. Because if you know that foundation, it would help you even in other situations, not just this standard.
Yeah, that's right.
Yeah. So let me give you one secret, right? You know, the normal elements are income, expenses, assets, and liabilities.
Yeah.
Over here, inventories, you really know that you are just dealing with assets.
Yeah.
And assets are of a debit nature, right? So when you reduce them, you have to credit.
Yeah.
Yeah, so let us start with that in a very, very easy manner. So I would have to credit inventory here, right?
Right.
By how much? By 20. Now, as for the other side, actually, you should never have to suffer about this, because when you say that you have debited something, things of a debit nature are either expenses or assets.
Okay.
Expenses or assets. So just by your own judgment, you could figure out everything. Let's say you had inventory. You had inventory. It's not like you have sold them. No, they have just fallen in value. Would you have an expense or an asset? Expense. Very nice. Now do you see this? So it's very easy. So you have an expense that would be taken to the statement of profit or loss, right?
Yeah.
And
So
since we are speaking, this is a statement of profit or loss. And since we are speaking of inventory, you could just go to the cost of sales figure. You should just go and adjust the cost of sales figure. Hello?
we are, yeah, so we are debiting the cost of sales for $20,
Yes, yes.
right? So I was right. Okay, I said that, but I was thinking like maybe I'm just increasing the cost of sales. Okay, good. No, good.
Exactly. That means we increase the cost of sales.
Okay.
So it's just like this. All right. After doing this, that means in your books, inventory would now be carried at 80, no longer at 100, right?
Right.
So after you do that, in case maybe the next year inventory has fallen again, this 80 will now be your cost, and that net realizable value would have to compare this cost of 80 and that new net realizable value, and then you'd proceed as usual. All right, so let's proceed.
Okay.
We are here now. As I told you, you have to compare cost and the net realizable value. We are done with how to determine net realizable value, and now we go how to determine the cost, right?
Right.
Now, cost of inventories. How do we determine the cost of inventories? Now, to determine the cost of inventories, we usually categorize it into 3 categories. Actually, it's not that much of a big deal. Let me just give you a single example, and before just coming through all these, because you could find them with like a list of something, but it's nothing. Let me ask one thing. Let's say you are in Canada, right?
Yeah.
You have bought goods from the USA. If you do that, actually, you would have to go to the port. You would have to go to the port, and you would receive the goods there. So you could be supposed to pay some import duties.
Yeah, that's right.
Maybe when you purchase the good, you could have been given the trade discount. So you'd have to, that means you won't have paid it. So it won't have to be counted on the price of that good. Then after that, from the port, you would have to carry your goods to your factory, let's say, or your shop. That's a transport cost. It will obviously be counted there. Or we call them the cost directly attributable to bringing the asset to the present condition. Yeah. But also, let's say, it could be that you have just purchased the materials and you have to work out those materials to finished goods before selling them.
Yeah.
So you could have incurred cost of conversion. So all these they have just been categorized this way, but you really know how to, if you really know how to approach them in a practical way.
Okay.
Yeah.
Yeah, right.
So you are given purchase here. They say purchase, cost of conversion, and other costs incurred in bringing the inventory to their present location and condition.
Right.
So in turn, we start with one item after another. But the good thing is that I have spoken to you already. We have discussed in a normal way, not in the way the standard was put.
Right.
Yeah. So you say the standard list. The following is comprising cost of purchase. For example, purchase price. Obviously, purchase price, but you have to less. Let me less again, less any trade discount, rebates, or other similar amounts. Because if you say that you have purchased something for $200, but there was a trade discount of $40, that means you didn't pay that. And it wasn't even counted in the books. I think, can you tell me the difference between trade discount and cash discount?
Trade discount and the cash discount?
Yes, yes.
So the cash discount is the cash discount that you can get it like if you're buying for $100, you're getting for $90, so $10 is the cash discount. And if for the trade discounts mean that you are getting the discounts, let's say you have to pay by within 10 days for the full payment, you will get the 2% of the discount. That is a trade discount.
All right, so the trade discount simply means that you are given a discount for bulk purchases, let's say for purchasing a lot of goods. but the cash discount is given for prompt payment, right? You pay
Yeah.
early, you are given the cash discount. Now let me ask you another question here.
Hmm.
I hope you have ever encountered something like discount received, discount allowed. You have encountered something like that, right?
Sorry, say that again.
Discount received, discount allowed. Have you encountered something like that in your former studies, in your earlier studies?
Yes. Discount received and discount allowed.
Yes.
Receive mean that you have received it, and allowed means like
All right.
I
My
don't.
my question is, are those cash discounts or trade discounts?
Which one?
Both of them, both discount received and allowed. Are they cash discounts or trade discounts?
They both are.
Mm-hmm.
It cannot be cash discount, because
What?
allowed means that you will be you will receive it, and the cash discount is actually immediate. So it has to be trade discounts.
Now let me tell you one thing, right?
Mhm.
Trade discount is never shown in the books. Trade discount is used just to attract someone to come and buy because they buy a lot of things.
Oh, okay.
So whenever you speak of discount received or discount allowed, both of
Mhm.
them are related to cash discount.
Okay.
Yeah, you should have to know that. If you have ever heard of something called list price, if you are given the list price, the price that when you go and buy something in the books is listed outside there. In business law, we usually call it invitation to trade. You find it outside there. That's the list price, that it is a price before removing trade discount. So if you are given the trade discount does not appear in the books. It won't appear in the books anywhere. So when we're told this is the discount received, that means when we pay early, we would have to pay less. So it's a cash discount. And discount allowed is we have allowed a customer. When a customer pays us early, they will pay
Mhm.
less. That is also related to cash discount. They are both related to the prompt payment, right?
Yeah. Right.
Yeah. So after purchase price, you could have import duties and other taxes. As I told you, when you bought
Can
car,
you, sorry, would you mind repeating the trade discounts again? Like how is it very much important in the from the exam purposes?
no, don't worry. The trade discount in the books is not important because it is usually not shown. But when is it important? It is important. Suppose you see this purchase price. Let's say this purchase price is called a list price. It is a list price. It is the price that you just find outside there in the shop, even before making any negotiations with the supplier, with the seller.
Mhm.
So that's why you have to deduct any trade discount so that you record the actual amount at which you have agreed to settle for the goods you have bought, right?
Okay.
Yeah, so after purchase price, let's say you purchase the good from the US, they have come to
Mhm.
the Canada port. After going to the Canada port, you will have to pay the import duties.
Okay.
I hope you pay import duties there, right?
Mhm.
Yeah, because they are usually imposed so as to discourage purchasing from outside.
That's right.
Yeah, so you could pay import duties and other taxes, provided they are non-refundable. Because if you pay something that is refundable, that means you haven't actually paid, right?
Yeah, that's right.
Yes. So something like this. But also after paying those at the port, you'd have to take your goods and go away to the office or to the warehouse or wherever you need them to be.
Mm.
So that's why you say transport costs, handling. We could be supposed maybe to load those goods in the car and unload them. So we call handling, and any other cost directly attributable to the acquisition of finished goods, services, and materials. So any other cost incurred here would also be required, right? And
Yeah.
so we will be done with the cost of purchase. We'll have to go to the remaining costs. We said there's cost of conversion and other costs. What are cost of conversion?
Mhm. Cost of conversion.
Yes, now this cost of conversion are when, when you have the goods and you need to convert them to be finished goods, you would have to incur extra costs to convert them into finished products. So most of these are incurred by manufacturing entities.
Yeah.
Yeah, so
Makes sense.
that's why you say this cost could be direct cost and indirect cost. Have you ever studied management accounting?
Yeah, that's right.
In management accounting, there is something called cost classification. You can classify costs as fixed or variable. You can classify them as direct or indirect, something like that. And so,
Right.
as for cost of conversion, you need to record both the direct costs and the indirect costs.
Yeah, that's right.
That's why we say cost directly related to the units of production, that is direct material, direct labor. All these costs have been written direct.
Mhm.
And then we go to the indirect costs.
Yeah.
That's why we say fixed and the variable production overhead. Overheads means indirect costs. That's the meaning of overhead.
Right.
Now, that's why I say we have direct costs and indirect costs.
Yes.
So these overheads are just overheads. It doesn't matter whether they are fixed or variable. You have to include them all. That's why you specified fixed and variable.
Makes sense.
And also they should be related to, you can have indirect costs that are not related to production, maybe they're related to marketing, to selling. So they should be related to production. If for direct cost, we do not need to say the word production, because if a cost is direct to the product, it's obviously a production cost.
Yeah.
Yeah, so you just need to know how to deal with fixed costs as well as variable costs. And down here we are. Of course, this is not very common to be asked, but you just need to know.
Yeah, that's right.
And if I could add something else here before proceeding, I could ask you again, have you ever studied in management accounting about margin and absorption costing?
Yes, I did.
Yeah, when when reading these ones, you have to bring together all the concepts, because it makes matters very, very clear for you. Marginal costing uses only variable cost, while absorption costing uses both fixed and variable, right?
Right.
So by that, we say that IS2, International Accounting Standard number 2 of inventory, uses absorption costing system. Marginal costing is never allowed by IS2.
What is not allowed?
Marginal costing is never allowed. Marginal is never allowed in IS2. Only absorption costing is allowed, right?
Okay. Can you tell me the difference between these two? Like what is marginal and what is the absorption cost?
All right. Simply speaking, what matters is the composition of costs that make the cost of inventory. If you say marginal costing, that means inventory is formed by variable costs only.
Oh, okay.
And if you say absorption costing, that means both variable and the fixed cost form part of inventory. That means full cost form part of inventory. We do not neglect some costs as long as they are related to production.
Okay.
Yeah, so these are just the normal definition. When told fixed production overhead, you know the meaning of fixed cost. They are just costs that do not change. Even when the activity level changes or the volume of production, they just remain the same.
Same. Yeah, right.
Yeah, and so, for example, suppose you are given in an exam how to obtain that. Maybe you are given the fixed production overhead is $80 million. To obtain fixed cost per unit, so as to know inventory cost per unit, you just we usually divide it by the normal capacity of production facilities. Do not divide by the actual production capacity, no, divide it by the normal production capacity, right?
Yeah.
If for variable production overhead, this has no issue, because if you need to know the variable production cost per unit, variable production overhead per unit, it would already be there. So just take it per unit and everything is fine. That's why they say they are based on the actual use of production facility. Variable costs per unit are usually constant, while fixed costs in total are usually constant. So if for variable production overhead, there is no issue, it's just normal.
Yeah.
And now lastly, let's take a look at other costs, and then we just go and take a look at an example. I would have to ask you some questions there.
Sure.
Before going to determining costs, leave this alone. The third component is other costs. So any other costs that have remained can also be taken. You just read the question and you'll find out whether they have been they are actually related to acquisition of inventory or not. So we say just take any other costs should be recognized if they are incurred in bringing the asset, the inventory, to their present location and condition. Sorry. So the standard list types of costs that will not be included in cost of inventory. So anything that is not does not form part of inventory, that means it has to be expensed as operating expenses, right?
Yeah, that's right.
And we are given them here. For example, let's say you have been told here abnormal amounts of wasted material and labor. This is just normal. Let's say you need to make a product, but maybe you are using labor that is not efficient, and then labor uses excessive material, or maybe a product loses quality, and then we have to rework. So we use 5 kilograms instead of 3 kilograms.
Yeah.
Those 2 kilograms that are excess do not form part of inventory. So they should be expensed for the period, and they should not form part of inventory. But also we are told here, storage costs, storage costs are only allowed when you are still making something. Let's say you are making something and you need to put it in store because it's not complete. But once a product is complete, you cannot capitalize those storage costs. They would have to be expensed.
Makes sense.
But also, I think this one is obvious, administrative overheads not incurred in bringing inventory to the present location and condition. In case you are given administrative overhead and no further information is given, it's obvious that they won't form part of inventory, right? Because inventory is related to production.
That's right.
Yes, and other selling costs. Selling cost is obvious too. Until you sell your product, that means it was ready for use. So something like that. And now we can proceed further.